Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. This video is going to focus on the SP 500. I'll talk about the ASX 200 in a separate video, and I'll leave a link for that in the description section below. I've also got a fascinating graph for you. It's a graph that could cause you to rethink what you think the market's going to do next, so make sure you stick around for that. Okay, as always, it's general commentary and doesn't take your personal situation into account. With all that said, let's get into our first chart. So we've got the SP 500 up on the screen, and look, there's been I think this is really shaping up as quite an interesting chart. So just going through it from the top, we've got this 3-point trend line which has developed since the January high, and so that's a key feature of this chart now that we need to monitor. And we've also got a situation where the current price of the S&P 500 is sitting below the moving averages. So I've got a 50 and a 100-day moving average on this chart. At the moment, we're below the moving averages, which does always make a market vulnerable when it is set up in that position. So from that standpoint, I think we need to respect that the S&P 500 still satisfies two of the key criteria really for a downtrend. And while all this remains the case, I think we really need to keep close watch for potentially another leg lower. But having said all that, we've also got to keep an eye out for positive signs, and there are positive signs developing on this chart. So firstly, we've had a breakout here. We've broken above the May high. So that's positive because what it does, it breaks this sequence of lower lows and lower highs that we've had in place for most of the year. And we've also had a strong rally off that June low, and with this recent pullback, we're now starting to see prices attempting to rebound from what's still quite an important area down around 3,900. It's where some Fibonacci levels came in, and there's also some support coming through from some previous highs. So the market's starting to rebound from an important level. So it's going to be interesting now to see what the next stage of this rally could look like, if that's what's going to happen. So let's jump over to the 4-hourly chart and get a little bit more detail on the recent price action. And so last week we're in around here. Last week I was talking about the potential for a rally. I was thinking that maybe this decline from the August high was nearing an end, and perhaps we're at a point where we're going to see what the market could do on the upside. What sort of rally could it put in place, and then that would give us clues as to, is this the start of a larger advance or just a pause before lower levels? And the reason I was thinking that we could see a rally develop through here is that through this period here, through this rally we had during August, we had a big breadth thrust in the S&P 500 where we had 90% of S&P 500 stocks getting above their 50-day moving average. So that's a broad-based rally in the market, which you typically see during a larger period of advance. And there was also increasing bearish sentiment creeping into the market over the previous week or two. And when people get increasingly bearish, and we had a couple of big down days, people started talking about an imminent break of the June low. It was just a sign that maybe people were getting too negative, and that could be cause for the market to be close to some sort of a bounce. So look, I thought it was worth keeping an open mind and not just having a knee-jerk bearish reaction to this pullback that we've seen through August. And it looks like, just in the last couple of days, it looks like the S&P 500 may now be trying to start to engage with some sort of a larger upside move. And I think this is where technical analysis really can help us. And I think that the structure of the rally, if this rally does develop, or whether it be a consolidation that then starts to move sideways, what that looks like, the way that's structured, I think that's going to tell us a lot about how to be positioning our portfolios over the next, possibly over the next several months. And from a bullish standpoint, so I'm just going to duck back to let's go back to a daily chart to look at this. So from a bullish standpoint, what we really need to see now, we need this rally off the low from this week. We need this to actually gather a bit of momentum. We want to see like quite a strong thrust upwards that takes us back up to near this trend line. Then maybe that opens the door for some consolidation over who knows what the time frame could be. It could be several weeks, could be a month, could be more. But then that would open the door to a breakout above this trend line, which then puts another bullish sequence into play. So that would be a positive. That would be the positive sort of price action that we're looking for. And this is really where the buyers are coming in where we are now, actively buying this dip and setting the market up for potentially another advance. Doesn't necessarily mean this would be a new bull market if that were to happen. Like, this could all still be part of a broader popping formation that might still take many more months to develop and completely play out. But it could still lead to several months of rising prices prior to another leg down. There's so much on the table. There's so much uncertainty still. We're really trying to navigate this small bits at a time rather than make big sweeping calls about big bear markets or big bull markets. At the moment, we're looking for the possibility that this rally does extend. On the bearish side, what we don't want to see happen, let me just sketch something in. What we don't want to see happen is a kind of a lackluster consolidation over the next several weeks. So I've drawn the pattern in first, and now I'm going to fill it in with the price action. So this would be some sort of a bearish sort of flagging pattern where the market just bounces sideways for several weeks, potentially a week to 4 weeks, maybe a bit longer, and then from there it starts to roll over again. So it's quite different price action to the bullish side. The bullish side was a strong rally and then sideways. The bearish scenario, it's going to bounce along the bottom and then potentially roll over. So that's why I say the next bit of price action is going to tell us quite a bit about where this market is probably going to go over the next several months. It's how it sets up in here. And if we do get that sideways sort of process, that could really be the setup for another sell sequence. So as I say, it really is a case of watching this price action and seeing how it develops. And look, if you're getting value from this, please hit that like button, and if you haven't already, hit the subscribe button, because it's really important signals that sends out to YouTube. It tells YouTube that people are watching and engaging with the videos, and they show more people, and if people are watching, I make the videos because they're there to be watched. So please do that. It helps me immensely. And also leave a short comment, just, hey, thanks for the video. Just again tells YouTube people are watching and engaging, and it helps so much in getting my work out there in front of people. Otherwise, it's hidden away and not enough people see it. So please do that for me. It helps heaps. Now, what have I been doing this week? I've been adding a bit of exposure, a little bit more exposure to the market. And I'll show you how I've been doing it. I've been doing it through the Russell 2000 is how I've approached it this week. So this is quite an interesting chart setup. So what we've got with the Russell 2000, which is the US small cap index, we've got a bullish wedge on the chart. It's a really clearly defined, nicely structured. It really is a textbook bullish wedge. Market broke up from that in July, had an initial strong move higher. It's now pulled back to near where the breakout point is. So this is all going kind of to how you'd say is a textbook wedging formation and playbook so far. It's also come back to some support. There's support here around 1,790 thereabouts, where the market's just rebounding from at the moment. I also like the market's rallied. It's broken above the 50 and the 100-day moving averages. It's had a pullback beneath them, which often happens at the start of an extended move higher. So there's some positive stuff going on. So the key now is, are we going to get a follow through rally, or is this rally going to peter out quickly and then start to roll over again? So look, I don't know. Of course, I don't know the answer. Nobody does. But when I look at this from a risk-reward perspective, and that's I think the best we can do with these markets. We've got to look at everything from risk versus reward, and we want to play when we see the odds or the payoff in our favour. And I think there's a case for getting some exposure to this market based on that. So, should this market rally? If it were to rally. Let me just measure some stuff out. So where the market currently is, where the Russell currently is, if it were to rally back up towards this resistance band at around 2,100, that's potentially a 15% rally. If it were to go midway back into this range, which held it for it was almost a year, I think. We'll go midway through that. Well, then we're looking at maybe a 20% rally. Not predictions, possibilities. A possibility of what could happen in the Russell. Even if the bear market is still in play as we go into 2023, there's still room potentially for a much larger bear market rally or even a new bull market. We need to see how it unfolds, but there's some good upside potential there. The risk, well, I think the risk is quite contained at the moment. I'd be looking to exit if it broke down below these this nearby support. Could have a tighter stop as 5 or so percent. So good upside potential with limited risk. So it's all part of my incrementally getting back into the market playbook that I'm using. So as you may know, if you've been watching my videos over the last few months, so the last 2 months really, I've been talking about this incremental re-entering into the market. So if a rally does develop, I've got a base position, and then I can continue to build on that base. But if it rolls over, I'm not overly exposed, and I'm able to make a quick exit without doing too much damage. So as I say, all about managing that risk. Now, just want to quickly show you a chart, fascinating chart which turned up on my Twitter feed during the week from the guys over at Sentiment Trader. And what this is doing, and this is another reason why I don't want to get locked into a overly bearish mindset as so many people currently have locked themselves into. What this is doing, it's showing institutional trader positioning in options. And what it's essentially saying with this big spike we've seen to the downside is there's a lot of hedging going on for a significant fall in the market. Last time we saw this much hedging going on was down near the bottom of the GFC sell-off. There was still further selling to come, so it doesn't tell you there's a low in place. It just tells you there's a whole lot of negativity, and mass negativity tends to come near the lows. So time will tell whether this has another leg down or whether indeed this is going to be, all this hedging is going to provide fuel for a further rally in the market. So it's going to be really interesting to watch. So look, I think let's leave it there for this week. Lots of interesting stuff going on. Keep a close eye on that price action, and I look forward to coming back next week and seeing where we are then. So until then, bye for now.